After a period of sluggish post-pandemic growth and weak domestic demand in China, authorities are acting to keep the economy afloat. In recent months, Beijing has stepped up its monetary and fiscal stimulus, cutting interest rates and issuing more sovereign bonds to help banks encourage consumers to borrow. This has led the IMF to revise the nation's growth forecast to 5.4% in the third quarter, an upward revision of 0.4%.
The reason we upgraded with two reasons for it. One is the third quarter GDP growth came out stronger than we expected, and it was importantly driven by stronger consumption than we had expected. So that was one reason. And the second reason is the additional fiscal stimulus that was recently announced. That is raising growth for this year.
According to British multinational bank Standard Chartered CEO Bill Winters, China's electric vehicle sector is seeing stellar growth, with the country capturing almost 60% of EVs sold globally last year. This is despite growing headwinds in the country's real estate sector and weak consumer demand. However, China's exports continue to decline for the sixth straight month in October, shrinking by 6.4% to less than $275 billion. Beijing, in its efforts to strengthen trade and exports, has begun to soften relations with its neighbour down under.
A sound and stable China-Australia relationship serves the common interests of the two countries and peoples.
The two have had a rocky relationship since 2020 after Beijing imposed several trade sanctions on Australia on products like barley, beef, timber and coal. But as China focuses inward, maximizing trade relations in the region will help boost domestic production for both countries as global demand rises.
I noted very much that unimpeded trade was in the interests of both countries, was good for Chinese consumers as well as Australian exporters.
In October, consumer prices fell 0.2% in China, much below market expectations of a flat figure. And as China seeks to avoid a deflationary cycle, boosting trade and local production will help stimulate demand for its products. Emre Boz, TRT World.
For more on this, we are joined by Liang Ding live from Shanghai. He is a microeconomist and currency strategist. We're also joined by Duncan Ringley live from London. He is an economist and chief China for Pantheon Microeconomics. Thank you very much for joining us today. Liang, I will start with you and from the good news, because we've seen strong consumption, but also monetary and fiscal stimulus. Where is consumption improving the most, and what is the extent of the stimulus that we can expect at this point?
Okay, also we can see, if you look at the consumption, also we can see really strong reopening-driven in the reopening-driven sectors like tourism and catering and restaurant. The year-over-year growth is around 10%, is actually above the level pre-COVID. But on the other hand, we have also a very weak demand in the durable goods, like mobile phones, but also in the housing-related sectors. But another spotlight in the consumption is actually the cars. So regarding the additional fiscal stimulus, I think there are two. I think that the government has already cut the existing the interest rate for the existing home loans. Almost 19% of the home loans have now a lower rate than before. Our average was 70 basis points lower than before. And another thing, what I think the government can do is to spending more in the social welfare sectors like education, like wealth, or like health, but also like in the job creation.
Right, and Duncan, as we often point out, Chinese inflation dynamics have been completely different to most other countries. Do you think that this additional stimulus that Liang was talking about will be able to reverse this trend?
I think it will make a very slow difference to this trend. I mean, you have to understand the fundamentals here, which is consumption demand and other demand in China is relatively soft for China and is likely to remain so, going into next year, certainly. But on the other hand, production supply is ample in China. China is a massive factory location, and a lot of investment is still going into manufacturing investment, leading to more supply. So this is why producer prices are still falling in China, and export prices, things that China exports to the world, are falling. And that also has an effect in terms of dampening consumer inflation too.
Right. Liang, do you agree then the monetary policy divergence between China and other major central banks, obviously one of the reasons of a weaker renminbi, as we were saying, how desirable is this for China on the one hand and for the rest of the world?
Yeah, I agree with you. I think the renminbi has depreciated year to date around 6% against the US dollar. But if we look at the valuation of renminbi against other major currencies, actually, I think since mid-August, China has de facto pegged the renminbi against the US dollar, and US dollar renminbi has actually appreciated against most of other major currencies in the world.
Right. Duncan, let's talk about electric vehicles a little bit as well, because as we mentioned, China is gaining a large EV market share. What does it mean for car makers in the West, both for EV makers, but also the traditional car makers? And also, what role is China expected to have in the energy transition in the near future?
Well, we're already seeing Chinese exports of EVs to the world increase quite quickly. If we look at somewhere like Western Europe, for example, we see an interesting pattern, which is a large share of Chinese-made electric vehicles are actually under foreign brands, or they're Chinese-owned brands, but they're European, well known as Volvo or Polestar, whereas actual pure Chinese-owned brands are relatively small. And we can already see that the European Union has initiated an anti-dumping investigation into Chinese electric vehicles. So I think we can anticipate that this pattern is going to remain, which is to say there's going to be limited, there will be some room for growth in Europe, but it will be fairly limited. I think a lot more room for growth for Chinese vehicle exports will be outside of Western markets. Emerging markets. In fact, Russia is the market which has seen the fastest growth in all sorts of Chinese car exports this year, both conventional fuel and electric vehicle.
Really, really interesting. Before we run out of time, Liang, let's just focus on the concerns for a bit. The biggest concern being the property sector in China and the property developers, right? The IMF pointed out that Chinese authorities should accelerate the exit of non-viable developers and increase house price flexibility. What's happening in this sector, and do you think China is moving in the right direction?
I think it's fair to say after 20 years of non-stopping boom in the China housing market, now we have a completely different structures. We have demographic development, and we have oversupply of the housings, and the policies released so far have only, I think, marginal increase the demand for housing. So I think that over the time, many of the housing developers will leave the market, and I think they have no chance. Already more than 50 developers have already defaulted, so they have no chance to stay in the market. But I think to your questions whether the housing sector is moving in the correct directions, I think so. I think that China are thinking about a complete new strategy for the housing sectors. It will be focused on the rental, affordable housing, and housing for the elderly peoples. So we need a complete new strategy.